The stock market stands as a vital component of the global financial system, serving as a platform where buyers and sellers trade shares of publicly listed companies. Its significance extends beyond financial markets, influencing economies and individuals worldwide. The stock market reflects the collective sentiment of investors, impacting corporate valuations and fostering economic growth. This video explores the rich history of the stock market, unraveling its evolution and pivotal role it plays in the shaping of the financial landscape. To understand the stock market, one must delve into its fundamental workings. At its core, the stock market is a marketplace where securities such as stocks and bonds are bought and sold. Investors participate in this exchange, seeking opportunities to invest in companies they believe will grow and generate profits. This process contributes to capital formation, enabling companies to raise funds for expansion and innovation. Throughout this video, we'll explore the mechanics of the stock market, shedding light on the intricate processes that underpin this dynamic financial system. Early origins of stock trading. The roots of stock trading trace back to the 17th century, a period marked by burgeoning trade and economic expansion. In this era, notable developments in Amsterdam and London laid the foundation for what would become the modern stock exchange. The Amsterdam Stock Exchange, established in 1602, is widely considered the world's first official stock exchange. It originated from the Dutch East India Company, where shares were issued to investors, providing them with the ownership stakes and a share of the company's profits. London followed suit with the London Stock Exchange, which formally took shape in 1801. Like its Dutch predecessor, the LSE evolved from informal gatherings of traders to a regulated marketplace for buying and selling stocks. This early exchange facilitated the growth of joint stock companies, allowing investors to buy and sell shares with relative ease. The emergence of stock exchanges during this period laid the groundwork for the evolution of financial markets, setting the stage for the intricate system we observe in today's global stock exchanges. The birth of New York Stock Exchange. In 1792, the New York Stock Exchange was established, marking a pivotal moment in the history of the stock market. The formation of the NYSE can be traced back to the actions of 24 stockbrokers and merchants who, in response to a lack of organization and structure in the securities trading market, gathered under a buttonwood tree on Wall Street. The historic meeting led to the creation of the Buttonwood Agreement, a seminal document that laid the groundwork for the formal establishment of the NYSE. The Buttonwood Agreement, signed in May 17, 1792, outlined the rules and regulations for conducting securities tradings and established the principles of trust and transparency among its signatories. This agreement reflected the nascent efforts to bring order and legitimacy to the growing financial activities in the United States. Over time, the NYSE evolved into a symbol of financial prowess, becoming the world's largest and most influential stock exchange. The Buttonwood Agreement, while a modest beginning, laid the foundation for the development of a sophisticated financial infrastructure that would shape the trajectory of the American economy. 19th century developments. The 19th century witnessed transformative developments in the stock market, largely propelled by the Industrial Revolution and advancements in communications and technologies. The Industrial Revolution brought in a paradigm shift in economic structures as industries mechanized and production processes became more efficient. This economic transformation had a profound impact on stock markets as investors increasingly sought opportunities in burgeoning industries such as manufacturing, mining, and transportation. The expansion of the railroad network during the 19th century played a pivotal role in shaping stock trading. The rise of railroads not only facilitated the movements of goods and people, but also spurred economic growth. Investors keen on capitalizing on the railway boom flocked to stock markets, contributing to the development of a more sophisticated financial ecosystem. Additionally, the telegraph emerged as a revolutionary communication tool, connecting financial centers and enabling real-time transmission of stock prices and market information. This newfound connectivity transformed the pace and efficiency of stock trading, laying the groundwork for the globalization of financial markets in the 20th century. The Great Depression and the Securities Acts of 1933. The Great Depression, a devastating economic downturn that gripped the world in 1930, had profound and lasting effects on the stock market. The crash of 1929, often considered the catalyst, resulted in widespread financial panic and a steep decline in stock prices. The causes of the Great Depression were multifaceted, encompassing factors such as the bursting of the stock market bubble, banking failures, and a general economic contraction. As a consequence, millions of investors saw their life savings evaporate and unemployment soared. In response to the catastrophic impact of the Great Depression on the stock market and the broader economy, the U.S. government implemented significant regulatory measures. One of the key legislative responses was the Securities Act of 1933, enacted to restore investor confidence and establish transparency in financial markets. This legislation required companies to provide adequate and complete information about securities offered for public sale. The Securities Act aimed to prevent fraud and misrepresentation, laying the groundwork for subsequent securities regulations and establishing a framework that sought to protect investors from unscrupulous practices. These regulatory initiatives were crucial steps towards stabilizing the financial system and rebuilding trust in the stock market after the tumultuous years of the Great Depression. Post-World War II and the rise of Wall Street. The aftermath of World War II ushered in a period of unprecedented economic growth, and the United States emerged as a global economic powerhouse. The post-war economic boom, also known as the Golden Age of Capitalism, saw a surge in industrial production, rising living standards, and an expanding middle class. During this time, Wall Street played a pivotal role in channeling capital and facilitating investment into the growing American economy. Wall Street, located in the financial district of New York City, became synonymous with finance in the global financial system. The New York Stock Exchange and other financial institutions on Wall Street served as crucial conduits for capital, providing a platform for companies to raise funds through public offerings and enabling investors to participate in these enterprises. The rise of Wall Street as a financial epicenter solidified the United States' position as a key player in the international economic landscape, shaping the trajectory of global finance in the post-World War II era. Technological advancements in the 20th century. The latter half of the 20th century witnessed a revolutionary transformation in stock trading through the introduction of advanced technological systems. One of the pivotal shifts was the advent of the electronic trading system. Before this technological leap, stocks trading primarily occurred on physical trading floors, where brokers and traders conducted transactions through face-to-face interactions. However, with the rise of electronic trading platforms such as the NASDAQ in the 1970s and 1980s, the landscape changed dramatically. Electronic trading replaced traditional open outcry methods, allowing for faster and more efficient transactions. This innovation facilitated increased market liquidity and accessibility as trades could be executed electronically, transcending geographical barriers. The real-time dissemination of market data also became possible, enabling investors to make quick and more informed decisions. Furthermore, the shift to electronic trading laid the foundation for high-frequency trading, a practice where algorithms execute a large number of orders at extremely high speed. The integration of technology into stock trading became a defining feature of the modern financial landscape, significantly impacting market dynamics and influencing the strategies employed by traders and investors alike. Notable market crashes and financial crisis. Throughout the 20th century and into the 21st, the stock market experienced several notable crashes and financial crises, each leaving an indelible mark on the global financial system. In 1987, the world witnessed Black Monday, a catastrophic event where the global stock markets, including the New York Stock Exchange, experienced a sudden and severe decline. The dot-com bubble burst at the turn of the millennium, leading to the collapse of many technology-related stocks and companies. The 2008 financial crisis, triggered by the subprime mortgage market collapse, resulted in a market recession, massive bank failures, and unprecedented government interventions to stabilize financial markets. These crises served as a harsh reminder of the inherent risks and vulnerabilities in the financial system. Lessons learned from these events prompted significant regulatory changes aimed at preventing a recurrence of similar crises. Governments and financial institutions implemented reforms to enhance transparency, strengthen risk management practices, and improve regulatory oversight. The establishment of new regulations such as the Dodd-Frank Wall Street Reform and Consumer Protection Act in the United States reflected a collective effort to mitigate systemic risks and protect investors. The impact of these events on financial regulations continues to shape the regulatory framework of global markets, emphasizing the importance of prudent risk management and robust oversight in maintaining a stable financial system. Globalization of stock markets. The latter part of the 20th century and the early 21st century witnessed a significant globalization of stock markets. What was once predominantly a US-centric phenomenon expanded to encompass a truly global reach. This expansion was fueled by various factors, including advancements in technology, increased cross-border investment, and the liberalization of financial markets. Stock markets outside the United States experienced substantial growth, with major financial centers emerging in Europe, Asia, and other regions. International stock exchanges played a pivotal role in this globalization trend. Stock exchanges in London, Tokyo, Hong Kong, and Frankfurt, among others, became integral components of the global financial system. Cross-listing, where companies from one country list their shares on a foreign exchange, became a common practice, enabling companies to access broader investor bases. Additionally, technological advancements facilitated seamless cross-border trading, contributing to the interconnectedness of global financial markets. The globalization of stock markets not only provided investors with a more diverse range of investment opportunities, but also posed new challenges related to regulatory coordination and market stability in an increasingly interconnected world. Modern challenges and trends. The contemporary stock market landscape is characterized by dynamic trends and challenges that reflect the ongoing evolution of the financial industry. One prominent trend is the rise of high-frequency trading. High-frequency trading involves using the use of sophisticated algorithms and computer systems to execute a large number of orders at extremely high speeds. While HFT has contributed to market liquidity and efficiency, it has also raised concerns about market integrity and the potential for abrupt market fluctuations. Another transformative factor in recent years has been the influence of social media and retail investors. Platforms like Reddit, Twitter, and online forums have become influential sources of market information and sentiment. Retail investors, empowered by online brokerage platforms, have played a more active role in stock markets, challenging traditional dynamics and contributing to the phenomenon of meme stocks and coordinated trading activities. Amid these trends, the stock market faces various challenges and debates. Regulatory frameworks are being scrutinized and adjusted to address the implications of technology-driven trading at the rise of retail investor influence. Questions about market manipulation, investor protection, and the overall stability of financial systems are subjects of ongoing debate. The democratization of finance, while empowering individual investors, also introduces complexities that require careful consideration by regulators and market participants alike. As the stock market continues to evolve, navigating these modern trends and challenges will be essential for maintaining the integrity and functionality of global financial markets.